If you want to see how the biggest players in the world buy Bitcoin, you're looking in the wrong place. Because the real buying doesn't happen on exchanges, it doesn't show up on charts, it doesn't push price, and you won't notice it until months later. But the selling, that's always loud, that's always public, and that's what moves the market. People have started asking, why do giant institutions accumulate Bitcoin in silence but dump it loudly? And who does that really benefit? There are two Bitcoin markets. The ones you see, exchanges like Coinbase, Binance, Kraken, etc. Here, price jumps, order books flash, and the whole world watches. And the second is the one you don't see, the OTC market, standing for over the counter. This is where hedge funds, ETFs, family offices, and multi-billion-dollar institutions buy Bitcoin directly from miners or large holders without creating buy pressure. No green candles, no panic, no hype, just quiet accumulation. If you try to buy $500 worth of Bitcoin on Coinbase, nothing happens. If you want to try and buy $500 million though, you blow through the entire order book, price jumps instantly and everyone notices. And that's what institutions don't want. Big buyers don't want to announce their arrival, they want to accumulate without waking the market. So they do the obvious, they buy OTC. Zero slippage, no liquidity shock, no public attention. But there's a second piece of the puzzle that most people miss. They also sell publicly. Exchanges are where the liquidity is. If a big player wants to unload fast, they sell on exchange. And here's the effect. Selling is visible, selling creates fear, and selling drives price down, whether intentional or not. Public selling creates one outcome. Bitcoin becomes cheaper for whoever is waiting to buy quietly. This is why retail traders see chaos while long-term accumulators see opportunity. This leads people to speculate. Is someone deliberately pushing price down? We can't prove that. But we can prove the mechanism exists, because in traditional markets, this playbook is old. Sell publicly, crash price, buy privately, but reaccumulate for cheap. Let the market recover. It's not conspiracy, it's strategy. And in crypto, where markets are thin, emotional, and reflexive, this pattern becomes even stronger. When an institution quietly absorbs supply OTC, they don't just buy Bitcoin, they buy it without paying the premium caused by their own size. Bitcoin is deeply liquid, globally traded, price transparent, highly reactive to the news, and emotionally traded by retail, meaning small signals create big reactions. A single large Coinbase outflow or inflow can move the narrative for days, and in a world where ETFs need inflow, institutions want long-term positions, and OTC desks are unlimited discrete purchases, quiet accumulation becomes the default strategy, not for manipulation, but for efficiency. Because in a finite asset world, the best way to accumulate is in silence. Now, this isn't necessarily about BlackRock being evil, even though they are. It's about understanding how large money behaves. Retail buys emotionally, institutions buy strategically, and if you're watching the public market to see where the money is going, you're already too late, because the real accumulation happens where nobody is looking.